And we are live. Good morning, everybody. Thank you for joining us. My name is Stephen Wall, co-founder of an entity called the Wealth Mosaic, based in the UK. So today, with my panelists, who I will introduce very shortly, we are going to talk to you and run through an interesting discussion on how well prepared are the banks for the next crisis. Obviously, we've been through or we're still going through a significant crisis. I myself am actually self-isolating at the moment, so I'm living it. But we're going to have 45 minutes of discussion. We're going to talk through this with the panelists. For the audience, we hope it's really interesting for you. You will have an opportunity to ask questions, and we will take those at the end. Quickly, from an administrative perspective, we will be talking for roughly 45 minutes. The session will be recorded and it will be available later today for your repeat viewing if you wish to do that. Quickly, I'm joined by Andrew Coles, who's Global Head of Solutions Consulting at Surecomp, by Chris Fragos, Business Development Manager at Profile Software, and by Nikos Karelos, who is Banking Director at Profile. So, gentlemen, welcome. Thanks for your time. Really looking forward to an interesting discussion today. I'm going to turn it over to Andrew straight away for him to introduce himself, his role, and talk through a couple of slides.
Thank you very much, Stephen. So yes, thank you. As Stephen said, my name is Andrew Coles. I am Head of Solution Consulting for Surecomp. Surecomp is a dedicated trade finance software provider. It's been providing software solutions to banks and to corporates now for over 30 years. In fact, it's that relationship that makes us quite unique in the market, is that we understand that the needs of banks with regards to providing and processing trade finance instruments, but also the need of corporates and what they need to manage their global trade finance business and manage their multiple banking relationships. We're currently embracing digital technology, and we have a very extensive marketplace available at the moment, where we're working at the moment with nearly 300 different fintech firms looking to provide digital solutions in the area of trade finance specifically. Chris, over to you.
Thank you. Hello, everyone. My name is Chris Fragos, and I'm client partner at Profile Software. I've got, to introduce myself, got a few years experience within the technology industry, management consulting, fintech and banking. The company, Profile, has over 30 years of history, starting from investment management, core banking, and other financial technology and banking services expertise around the software competency. We have 10 offices globally across Europe, Middle East, and North America. Our presence is in 45 countries in terms of our clientele, which comprises 300 more organizations with a really good client retention rate. I mean, the customer satisfaction is pretty impressive, which makes us very happy and very motivated to continue serving our clients. In terms of our range of solutions, it's quite a comprehensive range across the banking, but also across investment management and fund management services, starting from core banking in retail corporate banking, payment systems, payment gateways, but also very importantly in treasury management, banking treasury, and risk. Risk is a key component today in the banking industry, and our product covers all three major pillars of risk. Our newest product range is within digital banking, and also in the last 30 years, from the beginning, the early days of the company, wealth management, fund management, and custody were significant competencies in the company. Recent acquisitions have brought two companies in the group, in the family, and we will get the chance to talk about these later, if or offline, if there are questions in terms of how the company is structured and what are the competencies.
Thank you, Chris.
Over to Stephen. Yeah.
Perfect. Let's quickly do an introduction to Nikos, please.
All right. Thank you, Stephen, and hello, everyone. I'm Nikos Karelos. I'm the director of the banking business unit at Profile Software, and I would like to thank you all for joining us in this discussion today.
Super. Thank you, Nikos. Thank you, Andrew, and thank you, Chris. So, just quickly, if we return to the slides, you can see the discussion structure. So we're going to, first of all, talk about a little bit of the industry impact. So what has happened from this crisis and previous crises. We'll look a little bit then at challenges and opportunities. Then we'll look at the common ground among or between the crises that we've experienced in recent times. And then we'll move on to the future view. So what I said, 45 minutes discussing these themes, and I'll do my best to round up a nice discussion among the gentlemen with us today. So thank you again. So Chris, if I turn to you first of all, I think if I just make an opening statement, I think first of all, so we keep analysing the results of the recent pandemic, but it's come together after another big crisis, which is obviously the financial crisis, the credit crisis. Analysing what's happened between the two, I think we're going to attempt in this discussion, I think, to correlate the two and reach some conclusions. So just look at what's happened, look at what we can learn, and then reach some conclusions for the industry. So if we focus first of all on the impact, Chris, can you tell us how did a pandemic, which is effectively a social crisis, how did that end up affecting the banking industry, and what were the factors that led to that impact? What can you explain to us about that?
Thank you for that, Stephen. This is a social emergency in complete contradiction to the previous banking crisis, but the banking industry and society are utterly interlinked, both at consumer level, small business level, and corporate level. So the banking industry was strongly affected, and the results of this emergency were reflected on the banks. So we have two sort of essentially irrelevant events that seem to have similar results onto the banking industry to a certain extent. One point is that both retail and small business or business banking were affected, but in terms of how the banks reacted, we can see that maybe there was a slightly healthier banking and infrastructure and financial system to be able to react. The manifestation of this emergency had pretty much four different sort of pillars. One was practical social distancing. Customers were not able to physically access their bank and the branches, but also the branches themselves and the headquarters, offices, and so forth of the banks had to be shut for large periods of time or limited. So access of staff and also access to infrastructure for the banks was restricted. The other important thing that banks were not necessarily 100% ready to face was that the majority of the staff moved to remote working. So security, infrastructure, impact, and so forth. And the last sort of pillar was the creation of special sort of emergency products, especially around government response or central bank response to add liquidity and support to the economy. Over to yourself, Stephen. I think these are areas.
Perfect. So social distancing, closed branches, remote working, special products, and some of the impacts and the results, I should say, of what the banking industry did. Nikos, this is not the first time that the banking industry has been affected by a global crisis, is it? We know that very well. What about common characteristics between these crises? What can you identify as things that we can look at across the two?
Indeed, Stephen, and we do have the recent example of the credit crunch some years back. It was a very different period with no common characteristics in the regions that caused the two events. But having this as the most recent one, it would be useful to drill down into the details and the needs that eventually the industry was called to cover and support. There were major changes in investments that took place during that period, and the idea and what we're trying to do in this discussion is that we want to see if and how these changes helped the banks to be more ready and more confident to face a different, unknown, and unprecedented event like the pandemic. This may give a direction on what the appropriate focus should be on banks' operations and investments, so that, at least statistically or historically, the industry can feel more confident for the future, which, of course, is unknown to all of us.
Yeah. Perfect. So a little bit of future-proofing. Yeah, Andrew, please step in.
Yeah, no, perhaps if I can give a view, perhaps from the global trade perspective. In 2008, 2009, as it did with COVID, the pandemic had a huge impact on economies globally, which in turn has a direct impact on global trade. I think the OECD estimated there was a reduction in global GDP of about 3.4% last year, but a contraction of global trade of over 10%. Now, global trade is often seen as a lifeblood for rebuilding global economies. And as they did in the previous crisis, governments have looked to export support programs to fill the gaps as banks naturally become more cautious around providing trade financing. However, this pandemic is very different in its nature from the previous banking crisis, and it's very hard to draw exact parallels on what recovery might look like and how we should maybe be moving forward.
Okay, fantastic, guys. Interesting. So obviously we know the impact is significant. We know the industry has to step up, and there are similarities between the global banking crisis and the pandemic we're all experiencing now. Chris, if I come back to you, so if we drill down into the details of the recent period, there was a new element, right? And that new element is social distancing and lockdowns, right? None of us in our lifetime have experienced, or most of us, I would imagine, have experienced nothing like that. So what kind of impact has this had on the banking industry, particularly from the perspective of serving its end clients? What can you tell us about that?
Yeah, and thank you for that. I think, I don't want to use big words, but I think that there was a seismic effect. In terms of customer-facing operation, it was a seismic effect. We went from not only I mentioned earlier, not in accessible branches, but infrastructure headquarters were not staff and banking professionals were not able to go to the office and access physical infrastructure that sometimes was on paper. Yeah. More importantly, for small medium businesses or even large corporates, physically, we had the practical issue of closing down offices. So that affected the life cycle of the business. One positive somebody might say, one positive thing was that we moved even closer to a cashless economy, even at micro level. So online purchases went through the roof, and even small businesses, that was a challenge there. Small businesses that had a token presence in terms of their digital footprint, they had to go even more so into the digital sort of universe and allow for payments, allow for managing their accounts, their stock, deliveries, and all that stuff. So that, in terms of positive stuff, that forced digital penetration. But what we've seen, or a number of observers have seen, is that retail was well served in this. There was already a good penetration in terms of retail, but at a small business enterprise, less so, right? And for the small business, the bank branch is really was really important. And managing business current accounts or streamlining operations and onboarding new businesses or new products was a challenge. So how did the industry respond, or what were the best responses? Intelligently enabling investing in enabling technology that would change ways of working, that would change processes, would empower the response to these challenges. I don't want to take much more time on this, but I think this is a really important point for small businesses that we're trying to raise here.
Okay, yeah, fantastic. I know as a small business owner in the UK, I certainly had challenges communicating with my bank during the crisis. In fact, it was a nightmare. I won't swear, it was a nightmare. Hopefully, that's a lesson for them all to learn.
Not just the UK. Tons of all kinds of countries had more challenges than the UK in terms of digital penetration and so forth. So,
yeah, I'm sure, absolutely. Perfect. Thank you, Chris. Andrew, what about from the trade finance side? So, cash wasn't used because of the fear of spreading the disease, right? We were social distancing. We weren't using cash because who knows what's sitting on those pieces of paper. So what happened? Trade finance is a largely paper-intensive business, I believe. So what happened there? How did the industry cope? What did you see?
Yeah, thanks, Stephen. That's a great question. I mean, as Chris mentioned, there's these new factors around social distancing and remote working having an impact across the banking industry. Now, with trade finance, a large proportion of global trade still relies on these labor-intensive manual transactions processing due to the legal requirement that trade documentation is still in hard copy, paper-based format. Now, this has proven extremely impractical during this pandemic, where there's these fears around handling physical instruments, such as mentioned, around cash, but also adding to that the fact that the staff are remote working. So being able to get the physical documents to the processing staff that need them has provided an additional challenge. And that's really slowed down what is already a very slow process. Now, although many banks have made advances around the use of document scanning and modern back office processing systems, this burden of paper is still very prevalent. Now, I was wondering if you could show the slide. Now, here we go. So one of the actual benefits of the pandemic, if one can say such a thing, is that it's accelerated the adoption of certain digital solutions. The trade finance industry has been looking into the issue of paper for many years now, and there's several advanced initiatives that are proven and feasible. But the biggest hurdle to adoption has always been the legal, governmental and regulatory acceptance of these solutions to replace these physical documents. A major step forward has been a recent pledge by the G7 nations to accelerate the adoption of the UN CITRAL, the model law on electronic transferable records, or MLETR, which is about accepting digital negotiable documents to replace paper-based instruments that have been in use for millennia. Now, the figures that are quoted on this slide are from a report published by the ICC, and they look specifically at the business case for adoption of these digital instruments from a UK perspective only. However, if we kind of extrapolate these numbers and these figures on a global scale across the major trading nations, we can see that the argument is extremely compelling. Now, the good news is the G7 is not alone. We're seeing agreements between the UK government and Singapore to accept digital trade documents. And Singapore is also launching a thing called Trade Trust, which has been designed to bring harmonization and ensure legal validity of digital trade documents across the various countries and jurisdictions within the kind of sphere of influence, should we say, of Singapore. Now, from a solutions perspective and from a banking outlook perspective, we're looking at a time frame of 12 to 18 months before these changes, I say, come into force, but really kind of come into acceptance. And now it's definitely a time to be looking at what impact this will have and how best banks and corporates can leverage this opportunity.
Thank you, Andrew. One quick question. So with the Singapore initiative and other these things going on, I mean, are they new or were they long time in the pipeline? And can we therefore say that the pandemic's made them think, right, we really need to do something now? So they were happening, but there's a speeding up process taking place.
Yeah, as I said, a lot of these initiatives have been in place for a long time. The problem of paper is well known in the industry, and we've been looking at digital solutions for many years now. The hurdle has been around standardization. standardization and accepting, because we have to remember trade finance and things such as the bill of lading, these have been in existence for hundreds of years, and there's a huge amounts of legal framework around these documents that enables this global trading system to really operate and function in a secure and accepted manner. And getting that kind of consensus on a global scale to move to a digital document has been the burden, and getting standardization has been the blocker for these proven technology solutions to really be adopted. So what we're seeing with the G7, what we're seeing with Trade Trust, again, which is focusing on the ASEAN region, is really government bodies saying, yes, we have to abandon the old paper-based and we have to accept these new digital solutions. And they're providing now that much-needed step up that the industry's been looking for.
Fantastic. So it really is a kind of part of the ecosystem that needs to push this forward rather than banks or technology firms. It's legal firms, it's regulators, it's government, it's others involved. Fantastic. Nikos, Nikos, so apart from serving clients, so what are the challenges faced by banks in this special situation? What else can you tell us about the circumstances they found themselves in?
Yes, thank you, Stephen, because actually there were quite a few challenges that were faced by banks. I would like to start from what Chris has mentioned, the closed branches and the limited access to branches, at least, and the social distancing. Branches were not only closed for the clients. From one day to another, not only the branch officers, but the majority of bank personnel needed to be at home and continue working from there. And this was compulsory for everyone. And the personnel remained in rotation over quite a few months. Therefore, secure access needed to be provided instantly so that everyone could continue working from their laptops at home. And this brings us to the matter of infrastructure and access to the bank systems. Now, banks that were based on cloud infrastructure with new and modern systems, for them the transition was straightforward. But for banks that were relying on physical LAN access in the comfort of the local intranet, the task was a bit more difficult to carry out and ensure the secure access from one day to another in short timescales. Now, with bank staff being remote, also interaction between users was difficult and time-consuming, be it due to either internal bank policies or the system limitations. The requirement for user interaction to carry out certain operations proved highly inefficient given the special conditions. And at this point, we should mention support for automation in the banking systems. Automation is always a good thing, but now, especially under these circumstances, it became a necessity to ensure that no latency is imposed in the bank operations, and much more importantly, to ensure that with all the personnel being remote, the operations were at any time compliant to the bank policy. Therefore, for the operational needs that were identified, such as remote working, it seems that the technology and the investment on highly automated systems would enable or has enabled the business continuity fast and efficiently. Now, I would like to give the word to Chris. Wouldn't you agree with all that, Chris?
Absolutely, and I can think of another dimension there, not just operations and how to manage sort of the day-to-day interaction with customers and the internal functions of the bank, but also there was a pressure from the pandemic and its effects on creating new products. There was a product dimension there, and that started primarily by government mandated requirements to address liquidity issues and sort of society survival issues for small businesses or consumers. So we have examples like the bounce back loans in the UK, or the C-bills, or the EIDL in the US, that required flexibility in terms of managing eligibility, subsidization parameters, how to choose who's the appropriate business or not, how to disperse it, and all that. So this came from, not it wasn't a banking issue. It was just that businesses were closed, so they had trouble, often because of loss of revenue. Hospitality being one example, in terms of servicing their exposures, their debt exposures, right? So these new products came into the market, but the banks were the distributors of these products, and they had to react instantly because there was a pressure from the government and a need from society. So how to do that in terms of both rapidly launching those products and managing them internally, because there's risk. You can't just give money away. So they had automation of workflows, but also systems of record were affected. So the back end stuff, and in terms of building new rules in terms of actual loan management, or ensuring that special instructions in terms of payment and delinquency sort of rules were imposed, because that these are necessary. All this was done automatically? I don't think so. A lot of manual work was done, and this manual work took place by individuals that were equally affected as we all were by the pandemic. And some of them were isolating, some of them had to put extra hours, and all of them were working from home. Okay, so was everything manual? No, there was some degree of automation, some degree of manual. The question is, how much did it cost in terms of man hours and stress and to the banks? The conclusion here is that in order to address new products, special requirements because of circumstances in society and the market, flexibility and adaptability of systems, processes, and infrastructure are critical. Okay, and how to achieve that? How can we achieve that? By empowering the banks with intelligent application of technology, right? By being able to quickly configure and parameterize systems of record and customer-facing systems to address such things.
Yep. Great. Thank you, Chris. Thank you, Nikos. I mean, I think great answers and really interesting to look back, isn't it? Despite my comment earlier that maybe SMEs were slightly failed, actually in whole the banking sector did really well, and it showed that the flexibility of infrastructure, the adoption of cloud, things like this works very well. I know if we look maybe back 5 or 10 years, we might have run into many more difficulties in terms of the infrastructure flexibility to adapt to this. Nikos, as I mentioned, looking back, let's look a little bit back. So you've drilled down into the experience that we've all just gone through, and particularly what the banks have gone through. We then look back to the credit crisis. How close is it to that? Can you maybe tell us a little bit about what the experiences for the banks were during that crisis?
Mm-hmm. Sure, Stephen, thanks. Well, we did mention already that the cause for the credit crisis was completely different. However, we are able to identify common elements. The most evident similarity to start with is what Chris just mentioned on new products and restructuring. This need was what everyone was talking about during the credit crisis. There was a huge rise in NPLs back then due to different reasons, but still interposed heavy regulation, both regarding risk management and banks stress testing, requirements of capital adequacy, collateral allocation, as well as state-imposed restructuring schemes, special workflows, eligibility criteria. But this is an evident similarity. A less evident similarity is how access to digital services became a necessity during both periods. We already mentioned the cashless characteristic of the pandemic, with online payments being in focus because A, businesses were closed physically, and B, the use of cash was restricted due to fear of virus infection. During the past crisis, we also experienced restricted access to cash, but at that time it was in terms of liquidity measures or tax evasion purposes. Cash withdrawals were restricted, and this made it impossible to count on cash, and cash payments were limited to certain amounts. At the same time, electronic payments and transfers were unlimited. What was the result? The result was that even the most inexperienced banking-wise population were forced to use their debit cards for everyday purchases, while most of them were also forced to go digital in order to manage their payments, their transfers, and their statements. This happened 10 years ago when digital banking was not at the same levels as it is now. And the banks needed to urgently turn to whatever was necessary, either providing or enhancing the digital offering in order to face what was an urgent need back then. Well, I believe that this was when digital banking effectively became a reality and a need. And it was an investment that seems that has fully paid out during the recent period because there was one less factor to worry about, at least as far as the retail business is concerned.
Thank you, Nikos. Chris, Andrew, do you want to add anything into that point, or we have to move on to the future view? What's the next question? Okay.
No, nothing Chris, to add. That was very, very good response. No.
Yeah. Okay. Perfect. Well, thank you, Nikos. So, going back to Chris, thinking of everything there that Nikos just said, what happened during the credit crisis, and it led to the sort of engagement with digitalization and this investment in technology. It was the start of it in many ways. What do you think of the results? There were common needs, but they arose from different factors and conditions. How has this sort of helped the banks? What lessons have been learned, and what were the lessons for the future that the banks took on board?
Well, thank you for this question. There's quite a few lessons learned there for all of us, not just the banks and society as well. One key lesson or pattern that we've seen is that the previous crisis, and that Nikos alluded to it earlier, the previous crisis did help in terms of banks being better prepared to address an emergency, a pandemic, which is completely left field, from completely different nature. Banks were ready up to a point. They had already invested in tech. They had moved into digital. They had created more product flexibility. Most of the banks were already on that journey. Customers were forced away from physical banking. There was not the choice anymore, so the banking system was kind of ready to absorb the new wave of the last remaining customers, and banks were more fluid and familiar in terms of managing debt and restructuring products and really short life cycle products that were often government mandated, which is an important thing. Still, for small businesses, I think maybe we need to put a little bracket there in terms of how well they were served compared to consumers or large corporates. There is still that sense that maybe small businesses were not at the forefront of this. Yes, there were improvements, but maybe there is room for improvement. So I think that's another lesson learned from this point of view.
Thank you, Chris. Yeah, from my own sort of sector specialism, being wealth management, it's clear that there's still a long way to go. So, and I also think it's probably dangerous if they think they're done in any industry, right? Surely there'll be someone who surpasses them with a better model, a better product, a better discipline, a better mindset, whatever it happens to be. So let's move to the future view and let's sort of wrap up. We've been going for 35 minutes now, so let's sort of have a final 5 minutes on what we think is going to happen in the future. So Chris, if I can just come back to you first, what other factors do you see in sight here? What other influences are going to change the way banking is, whether it be regulation, whether it be products, whether it be, removing legacy from the industry, client requirements more? What does the future of banking look like? And, if we then think how a bank prepares for the next crisis, what does it need to bear in mind?
Well, I did mention small, medium enterprise and business banking. And I don't want to repeat myself, but I think this is a very important lesson learned here. In advanced economies or less advanced economies, small medium enterprises are the driving force of the economy, of employment, of cash, of pretty much everything. It's the headline. And being able to serve them as a banking industry better and being more responsive, more adaptable to their needs, that is an opportunity. And other crises will come, and we don't want to be unprepared. Now, things like creating marketplaces, servicing accounts, ensuring that the systems of record are in place to build new products, the ways of working, the interfaces with the small businesses out there, the digital enablement, capability in terms of payment, connections to accounting software, and all that stuff is really important. We don't know what's coming from the crisis, but responding creatively is the best we can do, right? And I think I don't know if Nikos agrees that there are other areas, but we can't cover everything. But yeah,
I could not agree more, Chris, with what you said. The SME sector, the business banking, is underserviced digitally, at least. And banks should focus into getting it at the same levels with the retail sector. Other than that, yes, we don't know what's coming, and we did not know what was coming prior to the pandemic. But we saw that banks that invested securely and in the right way in technology, in flexible products, at least these that we have identified as accelerators or enablers for the current crisis, this paid out. Sure, we don't know what's coming, but with every crisis and with the right movements, we can be more prepared, we can be more confident, making the right choices and investing properly, at least in the dimensions that we have just discussed about and identified over the crisis. What would you say, Andrew?
Yeah, couldn't agree more. Small business banking, corporate banking, it's long been behind retail in regards to the level of digitization. However, we're seeing greater acceptance to digital solutions. For instance, the digital trade documents I talked about, or accepting KYC, electronic KYC, or electronic onboarding solutions, for instance, that no longer require physical documents or visits to branch, or service centers. Remote working and digital solutions has been proven to work, and I truly believe it will become much more of the norm, not just as a reaction to the global crisis, but because of customer expectations.
Fantastic. Well, gentlemen, thank you very much for your contributions. I think it's clear the industry actually is in a reasonably good place, but there are weak points. Trade finance, business banking, corporate banking, banking for SMEs are areas where digitalization needs to improve. But actually, the industry has done pretty well through the crisis, and it has learned from things that have gone on in the past. It does have an infrastructure that is now more flexible and able to adapt to the environment that comes up. We don't know what crisis might come next, but let's assume one will in the not too distant future. But we can have hope that because of the technological adoption, because of regulation, because of maybe engagement with regulators and government, that things will improve. So Chris, Andrew and Nikos, Surecomp and Profile, thank you all for your contributions today. For the audience, as I mentioned earlier, the session is recorded, so it will be available for review and repeat watching later on today. Thank you, and enjoy the rest of your day. Thank you, gentlemen, and goodbye.
Thank you, everyone. Thank you, Stephen.
Thank you.
Goodbye.
Bye-bye. Thank you.